Fund Watch. Explore funds with the edge. This episode is sponsored by UBS Asset Management.
Hello and welcome back to another episode of Fund Watch by The Edge Singapore and UBS Asset Management. I am Amala Balakrishner and I'll be your host for this morning's discussion on China's complex, how you can allocate effectively. As the world's largest economy, political and economic decisions made by the Chinese central government have great global implications. The government's sudden clampdowns in tech and private education firms, for one, have spooked investors, many of whom have been investing through qualified foreign institutional investor programs and schemes, such as the Shanghai-Hong Kong Stock Connect. Market watchers have also seen a slowdown in investments made in China-based companies listed in Hong Kong, New York, and even Singapore. Estimates indicate that over $1 trillion has been erased from the market since the announcements were made. This number may well rise in the coming weeks amid fears that Beijing will come down hard on more industries. Joining me today to break down this complex is Gian Plebani, Portfolio Manager at UBS Asset Management. Hi Gian, happy to have you with us today.
Yes, hello Amala. I hope you can hear and see me well. Thanks very much for having me as well. It's always a great opportunity to talk to you.
Yes. So, Gian, we have received over 100 questions on this topic from viewers, with questions ranging from what the latest measures from Beijing mean to what industries our viewers should focus in terms of their investment strategy. So maybe to start off, what does the Chinese government's crackdown mean for investors? Is it just a temporary distraction or something that will impact investors' portfolio allocations in the longer term?
Right. Well, first of all, I feel honored, and it's amazing how much interest that topics generate. So I'm happy to answer as many questions as possible, but we might not get to 100, but let's see. Well, on this slide, you can see here, basically try to summarize the major regulatory attempts that we have seen over the last couple of months already, during this year, already starting actually late last year. I think the major takeaway here, it's very important to understand that these are targeted individual attempts to level the playing field in certain industries. So this is not a general clampdown on private companies. So that's very important to understand. It really is a targeted regulatory attempt with rationales in the different industries. And let's go one by one here. When you look at the first one here, the after tutoring sector, this is really a social policy. It's about basically taking the very strong financial impact that this sector had over the years on families, additional spending that they had, 30-40% of their income had to go to additional schooling and after school tutoring. And that's something that obviously the authorities in Beijing wanted to reduce the burden on these families. So that's more of a social policy. Whilst on the other side, we have the large technological companies that are mainly doing business on the internet, consumer discretionary companies, and others that have over time gained huge market shares. And basically these regulatory attempts here are to basically level the playing field here as well and try to avoid future market monopoly behaviors and therefore unfair price manipulation as well. And that's a very sensible approach, which also takes place in Europe and more and more also in the US with regards to these large tech companies. Then on the other side, we have seen in February this year, the government coming up with the 3 red lines for the property sector. And that's really about more deleveraging the overall parts of the economy that have been highly levered over the last couple of years, and certain companies that have developed sort of unsustainable leverage in their balance sheets. And that's a targeted sort of macroeconomic approach. So as I say, major point here really is it's not a general clampdown on private companies. It's about long-term stability of the economy and fairness for society. Yeah, sorry.
The context is actually really, really helpful to understand why the government is doing what they are doing and how it has affected the equity market, so to speak.
Right. Yeah. So, and then basically the other takeaway I would share with you on the next slide, actually, and this is just to show that really on a structural side, as I mentioned, there has been targeted policy from a regulatory perspective, but on a structural side, these developments do not affect the long-term underlying structural trends in China. As people are familiar, right, we have a very strong rising consumer sector in China with the middle class getting more and more wealthy, being able to afford more high quality products. So that's one major trend. We have very strong innovation going on. We have now more patents coming out of China than any other country in the world. So that's a major development there as well. And we have an aging society, which requires different services in the future. And we have still a very strong ongoing urbanization, which also requires different hard and soft infrastructure. So basically, these underlying trends are still continuing, and therefore investors that have been with us investing in these trends, they should still generate attractive returns over the long run, over the medium run, given that this is really a structural fundamental development. And just to make one last point, I mentioned before, this is not a clampdown on private companies. We have seen the private sector in China being so successful, right, to lead the developments over the last 20, 30 years. And the Chinese government is very dependent also going forward if they want to achieve their medium-term targets, like, for example, having a more environmental friendly growth for the economy, or achieving tech leadership, as they're talking about AI, 5G, quantum computing, and so forth. These are all fields where the private companies can be very, very successful and help the overall society and the government actually to achieve their development goals.
Okay, so Gian, you mentioned several sectors and several structural effects that we are seeing in China, from urbanization to aging population, as well as the private companies move into tech and AI. So how do you see these affecting China's equity markets?
Right. Look, when we look at the next slide, for example, this already illustrates, right, that we have had a very strong growth and performance coming through the Chinese equity markets. And as we can see, for example, here, the dark brown line overshooting the light brown line, this is the offshore market versus the onshore market. So we can already see what the development was. The offshore market is more dominated by the large tech companies, for example, the consumer discretionary, consumer services companies out there. And they have performed very, very well over the last year. So our investors actually could really generate very attractive returns. And this has been a major development, right? That these new industries have been rising in the weight of the index and have been led to attractive returns. On the other side, also, high returns always, or most of the time, come with higher volatility, right? So if you're invested in a single market in China, you have to expect markets to go up and down, and you have to expect some volatility. Therefore, it's so important to have a good diversification, to have an active investment approach where you can balance that out. And whenever you see risks in the market, you can move into, say, for example, more risk-off assets, say bond markets, cash, and so forth. And you can also try to move around and time the market in that sense and take off the risk for investors. But overall, the development has been very positive when we look at the line chart here for the last 5 years. And then the other major development I would highlight would be on slide 4, which basically is almost a conclusion from what we just discussed, right? That we had a very attractive equity market in China and these companies being very successful. And the other major development here is that the international community became aware of this, right? And they became very eager to be able to invest in China, and particularly also onshore China, which is something that is rather new and has opened up recently. And the Chinese administration has done a lot of effort to basically making these markets accessible to the international investing community by, as you mentioned in the beginning, right, Stock Connect, we have RQFI programs and so forth. And you can see what the result is here. There has been a tremendous push from global investors into the China onshore markets. And you can see here the light brown line, which is the bond market, and then the equity market, the dark brown line, which is actually catching up. But in total, you can see per each market, it's about 3.5 to 4 trillion renminbi of inflows that we have seen over, this is a 5-year period. So there has really been very, very strong interest. However, on the next slide, you can see even though we have seen such strong flows into the China onshore market, it is still very obvious that there is still a strong underinvestment, right? When you look at the international financial markets and you look, for example, compare it to the gross domestic product, so the size of the economy, and you compare China versus the US, as you can see here in the first circle, they're catching up very quickly, right? There are estimates when China is going to overtake the US. I'm not going to try to do that here, but definitely they're catching up very quickly. On the other side, when you look at the equity market capitalization, which is the second circle there, or even the bond market capitalization, you can see how very much behind these financial markets are in terms of their market cap compared to, say, the US, but also when you compare to Japan and Europe and so forth. So there is still, even though there has been such strong flow, still tremendous potential for institutional investor in particular, but also private investor to catch up and put more of their portfolio basically into China, as we expect these market capitalizations to increase globally.
I'm really surprised seeing these charts. First, we saw that there's been greater interest in China and equity investments, and then now looking at these, this slide over here, I'm shocked that investors are still pretty underinvested in China. So your sharing, Gian, just reminded me of two questions that we received from our viewers. So maybe I'll just start off with the first one, which is, it seems like international investors are focused on the onshore markets. So why would you say that large institutional investors are still positive on China?
Right. Yeah, it almost sounds a bit like that, right? So as I showed before, the flows into the onshore market. However, you also have to be aware that the offshore market has been accessible for international investors for a long time already. So therefore, on that side, they have been basically invested already, and the catch up really has happened into the onshore market because there has been more and new ways of how to access that market. So that's where the line comes from. But to answer your question straight away, both markets are very important for an international investor. If you want to have a broadly diversified portfolio that is capturing all the different opportunities in China, then you, first of all, can profit from the diversification benefit, as you can see in that slide. But second of all, you also need to be able to access all the different markets, to have the different sector exposures to achieve this diversification. And let me just demonstrate, these numbers are very impressive, demonstrate how much you can profit from the diversification benefit that China still offers. So being a market that is only recently opening up on the A-share side, you can expect that obviously the diversification between the onshore assets and the global investment universe, here it's represented by the S&P 500 and the Barclays US Treasury, but you could basically look at global investments as well. Obviously the onshore market, as I mentioned, being only recently opened up, it still offers the best diversification benefit. So you can see here, for example, when you compare MSCI China A to the S&P 500, you only have a correlation of 0.3. When you would compare other global markets, this number would be much higher, somewhere between 0.6 and 0.8. And even more impressive on the bond side, when you look at the China aggregate bonds, which is mostly government bonds, a little bit of credit, but onshore renminbi denominated bonds, and you compare them versus the global bond market, here represented as the US Treasuries, your correlation is only 0.2. So that means basically that only very few times when global bond markets go up or down, the same happens to the Chinese bond markets. And that is exactly what you want to achieve in a portfolio. You want to have a portfolio that has different asset classes, different allocations to asset classes, and asset classes which are zero or negatively correlated to each other ideally. And therefore, this is what institutional investors are after. And this is why you see these flows into the onshore market. So it's a very sort of professional investment approach and style, basically, which the private investors can also achieve by investing into a professionally managed multi-asset product for China. And that's what we deliver as well. And just for the bond market, just the last word here, particularly the global bond markets are very strongly correlated. Normally, you would see correlations between 0.8, 0.9 for, say, the developed market bond universe. However, as I said here, this is very unique. On the other side, you still have very attractive yields, right? I mean, in China, you can still have 2.5%, 3% yield on the government bonds, whilst most of the rest of the world is actually zero or negative. So therefore, no question explanation why it has been such an attractive universe for institutional investors. And just quickly on the next slide, because I mentioned, where is this diversification coming from, right? It is mainly driven by having access to the different sectors, and particularly on the equity side of the portfolio. You can see here that with the onshore portfolio, you're more invested in interesting topics like, say, traditional Chinese medicine, home appliances, domestic liquor, which is a sector that is quite interesting and large in the onshore market, whilst in the offshore market, and we're all aware of the large e-commerce companies, for example, but also healthcare has been quite successful over the last months and years, and financial services, they're also quite big on the onshore market, but they're quite different. So therefore, you really need to have access to both markets to have a diversified, stable portfolio.
Okay, so before I ask you my next question, Gian, I would like to speak to our viewers here today. If you have any questions for Gian, please feel free to leave them in the chat box, and we will try our best to have him answer them later on at the end of his sharing. So Gian, this slide, and as well as the numbers that you showed in the previous slide, are quite interesting and very impressive. I didn't know that, traditional Chinese medicine and domestic liquor were things that our investors can possibly look into for investing options. So we always see financial services, e-commerce, and health tech as the ones where people naturally gravitate towards. But since the onshore market also has opportunities, how would you suggest that investors can strike a balance between investing in the domestic and offshore markets?
Right. Yeah, let's jump to the next slide for that, because I think it's important for the listeners and the investing community to understand how diverse the Chinese investment universe can be, and this gives you an impression here. So when you look at the different asset classes, from dim sum bonds, US dollar denominated bonds, renminbi bonds, we have A shares, B shares, Hong Kong stocks, and a whole variety of different stocks like red chips, P chips, and so forth. So the art here is really, first of all, obviously to understand what the different asset classes are, then the second one, to access them, and thirdly, to build a stable portfolio which is well diversified among them, and to understand their characteristics, how they're correlated to each other, and so forth. So this basically shows that the best way to approach China, if you want to have access to the different universes, is really with a multi-asset portfolio where you have a good balance between stocks and bonds, but also within the stocks between onshore and offshore equity, between different indices. So China offers a lot of different indices. We have CSI 300, HSCI, we have FTSE A50, and MSCI China and MSCI China A, of course. Same on the bond side, we have a lot of credit indices, but also government and bonds and so forth. And really the mix is what makes your portfolio very stable and basically efficient over time. And that's how we allocate between the different markets to really access all of them. But just to give you a little bit more of an impression as well of what we think is very important in the Chinese market as well, is active management. And you can see that on the next slide, which basically helps to navigate the different market. As I mentioned before, there is high returns, but obviously it also comes with volatility. So it's significantly important to have an active management approach, because the Chinese market is, as we mentioned, still catching up to the other markets. Therefore, it is a little bit less efficient in a sense that there is less analysts, for example, look at the different stocks, looking at the different markets, doing less macro analytics. So therefore, there is still more potential for active managers to outperform the market. And how do you do that? Obviously by allocating between the different active managers within the asset classes, but also by navigating actively between the asset class. And here you can see how we have done that over the past in our portfolio. Just to give you an impression, the red bottom line there is our cash allocation. You can see how actively we move into cash whenever we feel the market is expecting drawdowns and when we see uncertainty. Whilst on the other side, you can also see the blue line there, which shows the equity market over time. And just for example, this year actually, we hit quite well in end of January, February. We started to reduce our equity market allocation. You can see we basically reduced about 10% 1% from an overweight into a neutral position at the early stage of this year, end of January, early February, and that actually was quite helpful, as you know, that the Chinese equity market, with the regulations that were put in place, particularly in February, got quite some hit, and therefore we basically actively maneuvered around this a little bit, and that is just to show how important it is to have active asset allocation from a tactical perspective. Maybe just to come back to your point as well, from a more strategic perspective on the next slide, slide number 10.
Maybe before that, Gian,
Yeah.
can I just ask
Sure.
you a quick question on, I'm surprised that cash had quite strong holdings in the portfolio. So it reminds me of a finding in UBS Annual Reserve Manager Survey, which shows that the average long-term target allocation to the renminbi is about 5.7% among your survey participants, which was much higher than the 5.0% in the previous year survey. So would you suggest to our viewers that it's the best time to introduce renminbi and more cash into their portfolio at this juncture?
Right, that's a great question. So my answer is not very straightforward, because it depends a little bit how your portfolio is built, right? So obviously these different asset classes interact. But first of all, yes, renminbi is very attractive at the moment. So why is that? If you're in a US dollar investor, for example, and you buy renminbi, it pays you 2.5% carry, right? Because the interest rate that you can generate on your renminbi is much higher than in the US. Therefore, you just get this 2.5% carry. On the other side, we also have seen actually the renminbi being very stable, even in the last drawdowns of the equity market, which were combined with outflows out of the Chinese market for a couple of weeks that we have seen last. The renminbi actually barely moved, and that demonstrates that we really think that the medium long-term investors, they still trust in the renminbi. So there hasn't been a major outflow of renminbi assets in general, but then also the government probably wanted to keep the currency stable. They want to provide a stable universe for international investors, which actually made the renminbi very stable and attractive for the medium-term outlook. So therefore, if you're a medium to long-term investor, yes, renminbi very attractive, gives you a nice carry. I would definitely allocate more than 5% in my portfolio, but obviously, as we have seen before, international investors are still catching up, so I see where they are coming from. On the other side, if you have a little bit already a lot of risk in your portfolio, let's say you run a long equity and credit portfolio, then the renminbi can also be a good hedge at times, because obviously these asset classes are correlated. So if the equity market return is negative in China, most of the times your renminbi will fall as well. Just be cognizant of that. You don't want to put all your eggs into one basket. Diversification is really sort of the ultimate free lunch, and therefore, if you have a risk on portfolio, you can also use it as a risk hedge. But to answer your question, renminbi very attractive at the moment, pays you an interesting 2.5% carry, and we do feel that the currency stays about stable over the next 6 to 12 months.
That's great. So you have mentioned other instruments and other equities, renminbi bonds, HIT shares, red chips, P shares, ADRs, the list continues, right? So I think you were going to share with us on the other instruments that our viewers can possibly focus on at this juncture, right, Gian?
Yeah, exactly. I just to continue basically on the slide number 10 here, I just wanted to show a little bit the advantages of having an institutional investor doing sort of multi-asset investing is that we, not just on the tactical side, as I mentioned before, where we go into and out of cash, into equities, out of bonds, and so forth. What we also do is we reallocate our structural portfolio given the opportunities we get. And you can see that here very nicely, right? So back in June 2015, this is where our multi-asset strategy basically starts. It's been very difficult to access onshore bonds, whilst on the other side, very, very little A-share exposure has been out there. As institutional investors haven't been really used to use the QFI and Stock Connect programs yet. It's not been as popular as it is today. And you can really see how we basically have been early mover into that market. From the very beginning, we had A-share exposure, but also when you look at the onshore fixed income exposure that we built up significantly over the last 3 years. As you can see, this gray bar from zero to basically up to almost 20% at one point there in June 2020. 2020. So this shows that we are not just doing tactical asset allocation. What we also do for our clients, we look out, we monitor the market, and if there is new opportunities coming up, if there is financial innovation happening, we are going to be early movers to allocate structurally to these new asset classes as well. And this is, by the way, being quite successful. As you might know, that A shares, but also onshore bonds have been very positive returners, particularly in this year. They outperformed the offshore market.
Seems like I think everybody should just be looking at UBS portfolio and investing in that, because you've done all the groundwork for everyone, right, Gian?
Well, we're trying as hard as we can. Yeah.
Yes. So I think we have some questions from our viewers on what the kind of strategy that UBS Asset Management takes on when you create your own portfolio. And there's some questions that says what kinds of returns you would say it brings, as well as whether this strategy is aligned with the China's 5-year economic plan direction.
Right. Yeah, these are a couple of questions. Let me start from the back, actually. So this is a great question, because we have always been of the opinion that compared to other economies, obviously politics has a major impact in China, right? It is more of a centralized state-led economy rather than a completely free market economy, as you can see, or as you find, for example, in the US, or a little bit less, but also in Europe. And this basically leads to the situation that you have to do very, very careful political analysis in China. So we are really reading every paper and news that comes out from the government officials, and every party meeting, and all communication is very, very important to the economy. And therefore, yes, we are basically looking at, okay, which different sectors does the Chinese Communist Party and the government try to go into over the medium to long term, which is the technological sectors that I mentioned before, right? They want to have a world-leading semiconductor industry, for example. They want to have leading AI technology. They want to, on the other side, also have a more fairer economy, and we have to be cognizant of that, right? They want to have a social level playing field. We need to be aware of that, which is one reason why we are moving around our portfolio. We're entering or exiting, in this case, for example, the tutoring sector and so forth. So yes, we are definitely very cognizant of political developments, and we're structurally allocating to these sectors, as I mentioned, that we think will outperform due to the government general direction over the next 5.
That's great. There's another question that we received on what is the best way for investors to access the onshore opportunities?
It's the UBS multi-asset strategies.
That was the obvious answer, right?
Yeah, exactly. No, look, there are obviously several ways, right? I mean, onshore is, I guess you're referring to the A share market, for example. On the equity side, there are very, very successful A share active managers, like UBS, for example, has one as well, when you just want the equities. I think, just one comment here, I think it's very important in China to be actively invested, because there is so much alpha potential, as I mentioned before, given that the market is still a bit more inefficient compared to other developed markets. There is so much potential for proper analysis and active management to actually generate alpha. So therefore, there is lots of funds out there. There is access through Stock Connect, mainly, that the investors are using, and therefore, active equity management in China is the way to go. On the other side, on the bond side as well, there you would have to find a manager as well. It's a little bit more difficult to have things like ETFs and stuff, for example, as exposure. It's still, the market is only coming, it's still growing. These financial innovations are only happening slowly. So therefore, as well, I would go with an active manager on the bond side as well. But at the end of the day, the combination obviously is what gives you the best potential for capturing the great growth potential that we have in China still, right? It's the largest, biggest growing economy out there. You definitely want to get access and more exposure to this growth potential. But at the same time, you can combine it with a multi-asset strategy. You also generate the income, right? A very attractive high yield market, for example, that pays you 110% basically on top of the US yield. So that is the combination of that is what really makes it very attractive and where you can achieve the best diversification benefit as well. So for me, it would be really a multi-asset investment with regards to China.
Okay. So Gian, there are a few requests for you to repeat the name of the UBS fund, as well as to share very briefly in a few 10 to 15 seconds about it. I think some of our viewers came in a bit later, so they didn't manage to catch that portion.
Right. Okay. So what are the big advantages for multi-asset investment? You can actually get a one-stop single access to China managed by UBS. It's a China Allocation Opportunity Fund. And it basically helps you to reduce the volatility that you get when you invest in China, whilst it basically allows you to follow the institutional smart money that is at the moment going into China. What we do is we build a 50% equity, 50% bond portfolio, roughly, but with very, very strong bands that we can move in and out, which are on slide 11 here. You can see that we can basically move around 35% from 25 to about 45 in H shares. You can see ADRs. We can go in all sorts of different asset classes and very, very actively manage risk off and risk on with our cash position that we go up to 20%. So this is really what we deliver to the client: single stop access, highly active management that provides you better risk adjusted returns for your China investments.
Thank you, Gian. So there's another question on how you expect the spread between A shares and offshore equities to evolve in the future. Now, I think this is a bit asking you to crystal ball into the future. It's a bit hard for you to say, I must say. But maybe if you have any sense or like guidance on this that our viewers can take note of.
A share versus H share. In the very short, actually, I'd prefer A shares. And this is the reasons is because the whole regulatory discussion that we touched upon in the beginning, that's still something that stays with us, I would say, for the next 6 to 12 months. There is still volatility coming in from that. And obviously, it is much more the offshore market that is hit by that, with the more exposure to offshore listed stocks, ADRs, to the large tax consumer discretionary and so forth companies that are targeted more by that. So therefore, we think that the onshore market is in the very near term more attractive. But structurally, as I said, you need this exposure to both markets, as you have different sectors, different industries that you can play actively and diversify among them. But yeah, as I said, in the very, very near term, the sectors in the onshore market are probably more attractive.
Okay. Now, Gian, we saw that China's factory gate inflation climbed by about 9% in July, faster than in the previous month. So this has come amid prospects of a slowing economy that has been pretty badly affected by the Delta variant and the resultant lockdowns across China that we have seen recently. So would you say that this means for the stock? What does this mean for the stock market? And would you suggest that investors should wait a little first before they actually go into deepen their presence and their footing in the Chinese stock market or equity market for that matter? Right.
I start from the back again. So first of all, you definitely want to have exposure to China over the medium term. At the moment, we would be roughly equity market neutral. That still means, though, that we're about 50% invested in the Chinese equity market. If you're underinvested still, you definitely want to invest. And the timing, if you go medium-term exposure, is a little bit less important. However, I acknowledge that there is the risks out there with the regulatory discussions that we had. And to your inflation point, that points more to macro risks. I don't think that there is a lot of macro risks out there. Why is that? So the inflation number that you quoted is really produced pricing inflation that has come through because of very, very sharp rises in commodity prices, which have been more driven by the global economy opening up coming out of a very, very strong lockdown, and the production also of these commodities have been hit quite hard. So therefore, there's just been not enough supply for this sudden opening up globally. And this is what actually led to the strong rise in imported commodity prices. But this has never and most likely will not translate into significantly higher consumer prices. So therefore, the risk to the economy from a macro standpoint is actually reduced, because we do think that this is an interim period, and particularly the production of these commodities will normalize very soon, and you will see falling inflation numbers in China over the next couple of months. So therefore, I don't think that the inflation poses a significant risk to the Chinese economy. On the other side, we do see that the Chinese monetary and fiscal policies coming out and actually stimulating the economy more than they did in the past. So therefore, we do expect that the economic slowdown, or it's not a slowdown per se, but the growth has been a little bit slower, will be supported over the next 6 to 12 months with government policies. They will turn around the fixed asset investments, and they will increase the stimulus, maybe even cut interest rates, and that should be positive for the overall macroeconomic growth in China over the next 6 to 12 months. So I don't see huge risks on the macro front, particularly not coming through the inflation side.
All right. So Gian, I think we have received a few questions from viewers on sector-specific questions, like whether you see any dangers or concern for the healthcare sector as well as the banks. There's been quite a lot of interest in banks as well as the bigger banks. So what is your outlook for these sectors, and do you think that it's better to wait it out, or do you think that investors should be going deeper in terms of looking into these sectors a bit more?
Right. In general, to repeat myself, the drop that we have seen, for me, over the medium term is a buying opportunity. So that's generally true, I would argue. But yes, I see the hesitation in the very short term. There is more risks to the regulatory side over the next 3 to 6 months. I think there is a lot of nervousness in the market right now. So whenever there is some comments coming up in newspapers or some even official government statements, there will be some volatility in the market. So if you're an investor that, say, wants to invest more short term and can't handle the volatility, then yes, it's probably sound to wait a little bit. However, if you want to build up a structural exposure to your equity portfolio in China that you hold for a while, then I do think it is a buying opportunity over the medium term. And if you can look through some volatility over the next 6 to 12 months. And to come back to your sector question, this really depends on what targets and what the next discussions are in terms of regulatory environment. I do think, however, overall that the Chinese government is now very aware of that, of the significant risks that are out there when they increase their regulatory pushes. So therefore, I don't think we will see sort of a repeat of what we have seen, including the very negative market volatility. With regards to the financial questions that you mentioned, I do think that with the more support from a monetary side that we see coming into next 6 to 12 months, as I was laying out before, I do think that the financials should actually profit from them, particularly onshore financials in the onshore stock universe should be quite supported by that, and the general sentiment should be improved by the government stimulus as well, or the marginal support from the government side. So therefore, I do think that financials are actually attractive for the next 6 to 12 months.
Yes, definitely. Based on what you're sharing, each of these sectors present great opportunities. And of course, there's a wait and see approach that we also have to take, because it's hard to say how things will shape up in the next few weeks or months for that matter. So maybe I just have 2 questions in closing. I believe you have answered almost all of our attendees' questions. So thank you all the attendees for your questions. So Gian, you see that US securities regulators have signaled that they will further tighten restrictions on Chinese companies seeking to possibly list on US exchanges. So do you reckon we will see a change in the kinds of companies investing away from the traditional tech-related ones that we've been seeing all this while?
Right. it has been a discussion for a while now that the US regulators, but also the Chinese regulators that we have seen, right, they expect more from these companies that are listed offshore, because they're also worried, particularly the Chinese regulator obviously is worried about data security, about what kind of information goes abroad when they have these companies listed abroad that actually collect a lot of data in China, but then are listed abroad. So that's very understandable in that sense, I would say. And what the medium term situation will most likely be that more and more companies decide against a listing offshore and will decide more, say, in mainland China or in the Hong Kong stock market as well. And we have seen quite some developments of that already over the last 2 years. Dual listings from ADRs coming back to Hong Kong, for example, or even some companies deciding against the Nasdaq and listing in Shanghai or in Hong Kong. And the conclusion of that is, I don't think that, I mean, this has no impact on the fundamental earnings potential of these companies, right? So that shouldn't have a major impact on the equity price per se. It's really just a question about listening. And on the other side of the medal, obviously, yes, the US regulator has demanded more strict rules and sort of publications from these companies as well. And that just reinforces that kind of development that I mentioned for these companies to maybe reconsider their listing. And I think that's a trend that will hold, but it's not a trend that will have or should have a significant impact on these companies' valuations.
So maybe, Gian, in closing, something that has struck me from your sharing is the need to have a multi-asset strategy. So
Right.
What is your personal investment strategy, and are there any tips that you can share with our viewers here today?
That's a good question. Right, so the two major things when you invest, in my opinion, personal opinion, is there's two things you can really profit from. The one is diversification. I mentioned that already. And the other one is compounding. And the effects are really astounding. So what you really want to do, you want to start as early as possible to build up a portfolio. Because the more years you add to this portfolio, the more you profit from this compounding effect. And this, at the end of the day, is most likely even way more important than how you invested, is how long you invested due to this effect, right? So I think that's a major point. So therefore, I try to put as much of my assets basically in a portfolio that I keep for a very, very long time. And I'm also able not to look at it, because you can always get nervous about short-term volatility, right? And that could lead to a point where you actually leave the market, but that's very dangerous. So because it's really hard to re-enter, and then you lose your compounding over time. So therefore, I think the first rule is invest early and stay invested and enjoy the compounding effects. You will be surprised in 30 years what your portfolio did for you. The second one is diversification, very, very important. There is always surprises in the market. There are industries that disappear from one day to the other, right? So if you're focused on single investments in a single industry or single stocks, it's very difficult to achieve a diversified portfolio that is very successful over time. Of course, sometimes you hit the right one, it can be very successful, but it's unlikely that you'll do so for 30, 40 years in a row, and therefore you enjoy the full compounding effect. So you have to avoid that your portfolio can be wiped out. And the major way you can do that is by having a broad diversification of portfolio. So basically, this is really the rule and the result, I would say. Build a portfolio which is broadly diversified. The younger you are, the more equities. You build a global equity portfolio. So for example, for me, I would probably add about 60, 70% equities. The rest you put in different bonds, in different asset classes to diversify as much as possible. And you want to have a global portfolio with different currencies, and you just stay invested as long as you can. That's the result. For the more short-term listeners, I do personally think that we have a buying opportunity. If you want to be invested in China for the next years, then this wobble and sort of volatility that we have seen is definitely a buying opportunity for you if you can hold through over the next couple of years. I do think that this is still, given the biggest growing economy, it's a very attractive market on the growth side, but also on the income side.
That's great tips. I think there is a strategy that each person can adopt based on his or her investment opportunities, as well as strategies and the kinds of funds and the risks that they want to take. So with that, we have come to the end of today's discussion. Thank you, Gian, for sharing your insights and tips on China's complex and how to allocate effectively. To our viewers, we hope these strategies have helped you to understand this complicated issue that we are facing, and these investment decisions that you make in the short and medium term will definitely yield you much profit. For more analysis on the stock market, you can visit the websites of UBS Asset Management or The Edge Singapore. I'm Amala Balakrishner, and with me is Gian Plebani, and we'll see you sometime soon. Take care. Goodbye.
Thanks very much, Amala, for having me, and thanks everyone for listening in. See you next time.